Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show, and I am Paul Winkler, talking money and investing. Retirement planning, because there is going to be that day where you are dependent upon your money. You work for money, then money works for you if you get this thing right. So that's kind of why I come at this from an educational standpoint. Because if you look at the returns of investors versus markets historically, the average investor so significantly underperforms markets, and there are good reasons for it. Stuff is not easy. You may think, this is easy, this is simple. I just saw this little ad, or I go to and go read up some article on investing, and it seems like everybody's telling you to do something different. And then you just kind of shake your head and go, I don't even know what to do because it's all confusing. Everybody seems to be contradicting each other. And you go through market upturns. And when markets are looking good, and let's say that you're investing and U.S. stocks are raging hot and doing very, very well, everybody's writing about how great the economy is, how wonderful the market is, how wonderful the president. The president's always taking credit for the market going up. I mean, I don't care which party you're talking about, both of them. If the stock market's going up, say, hey, look at the stock market. Look how great it's doing. They will point to that as evidence of their good leadership. And if it's Congress, they're going to point to it and say, hey, look how great we're doing. Now, if it's going poorly, you got to blame the other side, right? That's how it works. You can't take any of the blame. You got to take all the credit, is how politics works. And then you'll have, after markets go down, you will hear doom and gloom and how terrible things are going to be, and inflation's going to get, it's bad, it's going to get worse, and earnings are going to get worse, and the economy is going to go bad, and you're going to hear from some person that predicted the market was going to go down, and that person will be saying, see, I told you that this was going to happen. And you'll see all kinds of analysis on how bad the economy is going to be going forward and how you need to actually switch your investment strategy to something else. Get into gold. You need to get into silver. You need to get into self-directed IRAs. You need to buy real estate, blah, blah, blah. Well, that's hence the very first segment that I do want to talk about that very thing, because it was a topic that came up this week. Somebody asking about self-directed IRAs. And there was an article in Kiplinger about that very topic, and it was entitled 6 Reasons to Avoid a Self-Directed IRA. Now, if you've never heard of this, you can take matters in your own hand when it comes to investing all day long. The investment industry will let you do that. And when I say take it into your own hands, that's literally what a self-directed IRA is. It allows people to do things that you can't do, as Kiplinger points out, in an ordinary IRA, and that is invest in alternative assets. Now, this is something that the investment industry does too. Don't leave it to the investment industry not to screw things up just as well. That's exactly what they did in 2008, 2009. They started moving toward alternative assets. Think maybe investing in futures and maybe commodities, gold, silver, diamonds. Good grief, you can invest in trees if you wanted to. Lumber. You could invest in real estate. You could invest in individual stocks. Now, you wouldn't need a self-directed IRA to do individual stocks. You can shoot yourself in the foot with a regular IRA with that one. But that is really what these things are designed to do, is allow people to do things that you aren't normally able to do. And Kiplinger points that out. It says, self-directed IRAs are not for the average retiree or for the faint of heart. These specialized retirement accounts let investors do what they, and I use investors in quotes if I were writing this article, because it's really gambling is really what you're doing. You don't think of it as gambling. You think that you're prudent, especially as we get older. What we tend to do is we tend to actually get more confidence in our abilities. And the reason has to do, there's a psychological aspect to it. that people tend to get a little bit more confident. And the reason they get confident is because they feel like they've got so much experience. And the problem is that when we get a lot of experience, we start to see false patterns. And we start to say, well, every time in my life that this happened, this was the next thing that happened. I mean, right? It's just basically what happens. I saw this before. I read this book before. And I know how it ends. And what we don't realize is that it doesn't end the same way ever. And the reality of it is, if it did end, let's say it did end a certain way last time, you're not the only person that noticed that it ended that way last time, and everybody else is taking action based on it ending the way it did last time. So in other words, they sabotage it for you, and it doesn't work out the same way. And the problem is you won't get that lesson until you've lost your can, until you have really lost, in the game. And that's the problem, is it's too late when you finally learn the lesson with real money. Maybe you sort of learned the lesson when you didn't have real money. You didn't have a whole lot. And so this stuff is dangerous, and I heartily agree. David Roddick is the writer of this article. I hardly agree that it is something that, people just don't recognize how bad this actually can be. You talk about the faint of heart, you've got to really be willing to just lose it. Having worked an entire life and just lose everything that you've got because you thought you knew what you were doing. Now, it talks about investing directly in alternative assets, cryptocurrencies, real estate, and private businesses are some of the things you can do. Cryptocurrencies, we saw what happened there. There are a lot of people that lost their life savings right there and thought they really knew what was going on. Real estate, I remember, Griff, I got in this industry, and I was talking to somebody this week, and I says, do you remember the 1980s? You remember what happened to real estate? Oh, yeah. And I said, I remember too. And I remember how much bravado people had at that point in time, thinking that they have got this down. And the wealthy were investing in real estate at that time too. It was the most sophisticated thing you could do at that time. It was the thing that seemed like it was the most sensible. The tax laws were phenomenal. And it all worked until it didn't. It all worked until Congress came in and changed the rules. And then once they changed the rules, bam, you were done. The game was up. The jig was up, and it wasn't going to work anymore. You could do private business, and real estate. You get into these self-directed IRAs. You make one step, and bam, you have got a tax bill on your hand like you would not believe. You have a disqualified IRA. Now, some of the points in this article, I want to make some points because there's some really good things, even if you weren't thinking of doing a self-directed IRA. I think some of the points he makes in this article are worth hearing for anybody that has any type of IRA, because these are the things, and there's something in here I'm going to point out, because I pointed something out over 10 years ago about investing in gold, and I actually saw an article in the Wall Street Journal today. I was reading through this week's Wall Street Journal, the entries. And I was, oh my goodness, I must share this, because this is something I said about 14 years ago. I said, this is something I can see coming down the pike. And indeed, it's now. So I thought I would point that out because it was such a, as a vindication for something, and people are like, Paul, you're crazy. No, when I look at how things work in the investing world, things just make sense to me, and how things actually play out. It just makes sense. I mean, you can kind of look at things, not predict the future, not predict where markets are going, but you can see how certain investment vehicles that people make popular, how they'll blow up and what can happen to make them blow up. And it was just one of those examples, and I'll talk about that in a second. But anyway, it says, like ordinary IRAs, assets grow tax-free inside of a self-directed account, and you have these being marketed by big investment firms. And he says, now there are several problems with this. One of them is, the first one he brings up is number 1 of 6, is you're not as diversified as you think. And that is very, very true. Says alternative assets can be touted as a way to diversify your portfolio, because they don't move in lockstep with stocks and bonds. And they don't. And, back in 2008, alternative assets actually went up in value, and people said, hey, wow, this is really, really cool. This is a great diversifier. The problem is that you could go an entire 20, 30-year period with no return, or a return that is basically inflation, and that's it. Now, you may not get movement that is in concert with stocks or bonds, but, one of the things that you want to make sure you've got going for you when it comes to investing is getting return above inflation. And the problem with commodities is you're not producing anything. When I own a commodity like gold, I'm not producing a product. I don't have a cost of capital. Nobody's paying to use my money. So it doesn't work really well. And that's exactly what he says here is basically you're buying something and it may take a big chunk of your savings to do it. And the problem is you can end up with an asset that is just a single asset. Like buy a piece of real estate with your IRA, and you've got one piece of real estate. I'm sorry, but that's not diversified. When I own 20,000, 30,000 stocks, I've got lots of real estate, but I don't have it in one area. I've got it all around the world. So I've got a way, way larger degree of diversification when I do that. He says to diversify using alternative assets like real estate or commodities, you want to make sure that you're sticking with mutual funds. Now, that's one area where I would disagree. I would never own commodities in an IRA because there's no cost of capital. So I'm not going to agree with every single part of his article, but I think he makes a really good point about diversification. Now, why is that important? Well, there's something called the Prudent Investor Rule. Trusts, in order to be to fall within the dictates of the law, have to follow something called the Prudent Investor Rule. And there is a book out there. You can pick it up, and it's not cheap, but you can find it out on Amazon. It's the Restatement of the Law Third, American Law Institute, Restatement of the Law Trusts Prudent Investor Rule. And it's basically a book written, as it would tell you, to determine what's prudent investing. Because let's say if you're managing money for a child, and that child can't manage their own money, and you're managing it for them, you're going to be held to prudence because they don't want you to mess up this kid's money. Years and years ago, I used to actually write investment programs for the court. I actually did that years ago. I had an attorney call me up and he says, hey, could you write something the way I got into it, he said, could you write something for this child has inherited a large sum of money? As I recall, his father was a doctor, and it was a divorce, and he was getting a large sum of money and had to make sure, the child was a minor, had to make sure it was prudently managed. And I was like, sure. At the time, I needed the business. Quite frankly, I needed the money. So I charged a fee to write up a whole program for this child, going to school, how you do it, do everything. And I'll never forget the attorney getting back with me. And he said, I said, so how did it go? He says, well, the judge looked at it. He says, that was the most detailed plan he'd ever seen in his life. And he said, that was great. And I said, oh, good. Okay, so cool. But basically what I did is I followed the dictates of the Prudent Investor Rule. What is prudent? And one of the things it says in there, and I'll read it to you, it says risk and the duty to diversify. And it says, because all economic events do not affect the value of all investments in the same way. In other words, you may have a few really lousy years for real estate, but large U.S. stocks may do great. You may have an absolutely abysmal few years for large U.S. stocks, but small U.S. companies may do great. You may have years, well, quite frankly, where everything in stocks goes down and real estate, but cash is the only thing holding value. I mean, maybe one of those years that something like that happens. You may have years where stocks do poorly, but bonds do well, or bonds do poorly, but stocks do well. So the idea here is to own things in every area so that hence they don't all move in the same way. And that's what it says. It says, so risk or volatility, which is often referred to in economic literature as standard deviation, that tells you how much something can go up and down. Just imagine I'm walking up a set of stairs and I got a yo-yo in my hand. That's the way I like to explain this. I'm walking up a set of stairs, I got a yo-yo. How long is the string? Now you're focusing on the yo-yo as I'm walking up the stairs. The longer the string, the higher the standard deviations. The more you got ups and downs and ups and downs. You got a really short string, you're not going to see much ups and downs. You're just going to see me walking up the set of stairs, and it's going to be a very shallow up and down of the yo-yo with a really short string. If I've got a really long string, it's going to be up and down as I walk up the stairs, progressively going up, but you're going to have big deviations from the standard or the standard deviation or the mean return. So I might have an expected return for large U.S. stocks, and every 30-year period, it's about 10. It's about 10 historically has been the average annualized return from the 1920s till now. But how many years was the return 10? Pretty much never. You might be up 35%, down 15%, and up 20%, and down 10% for a year, and you're sitting there going, ugh. You hate it when it goes down, but guess what? That's the permission slip. If it weren't for those negative returns, we wouldn't see the higher returns that stocks give us versus fixed income. So basically what they're saying is that we measure risk in economic literature, standard deviation, which is in turn is a square root of the variance, and basically variance is how much it varies from the mean. And it's, just all this really fun stuff, but you're going, oh my goodness, that's math, and I don't like it anymore. But you know what? It's what it is. That's how we do it. And you don't have to know it anyway. It's something we know. So at least this is true unless the returns are perfectly correlated. That is, unless they vary identically. In English, what he just said right there is if I've got two things that move up and down together, one of them isn't needed. It's like if two of us have the same opinion on everything, one of us isn't needed. So hence, the problem with self-directed IRAs right off the bat is you've got no dissimilar price movement. They're basically moving together. And in essence, now, if the things that you've invested in go down in value, they're all going down together, and your retirement goes to heck in a handbasket all at one time. So that's one. Okay, another thing that they had in here is you get no guidance. So with self-directed IRAs, it's self-directed. You're the one directing the ship. I don't know what your degree is in, but, literally, when we use investment portfolios, where I'm going for information is Nobel Prize winning economists. And also going and looking, like, for example, one of the things that we often do is we consult people. One guy that won a Nobel Prize, Gene Fama, University of Chicago, Nobel Prize 2013. Another guy, Markowitz, actually won the Nobel Prize in 1990 for how you put together a portfolio. And this is a person that I would go to. These are people that I would go to their research on a regular basis to determine how to put the portfolio together. Because guess what? I know this stuff pretty well, but I don't have a Nobel Prize, number one, first of all. Second of all, behavioral economists. Also looking for people that actually work on behavioral economics, because we tend to shoot ourselves in the foot because of how we take action and when we take action. So if we understand ourselves better, we can actually put together a portfolio properly, but make sure that we don't deviate from it by understanding how our behavior affects our actions. That's another guy that is, as a matter of fact, one of the guys that actually endorsed my book, that I wrote a blurb on the back of my book, is a guy that if you go to college and take a statistics class, Lyman Ott is actually the author of many of the books that people in college use, and not only college, but graduate classes for economics and statistics. So that is the type of person. You get no guidance when you're trying to do this on your own, and you may be smart, but the reality of it is you probably don't know what you don't know. And that's what it gets down to. Now, another thing he says, and here's potential for fraud. Not only can you get investments that are opaque, but the Securities and Exchange Commission warns that criminals prey on those with self-directed IRAs. They prey on people that do this stuff. Why? Because they think they know more than they really know. And there was a study that was done, and it was actually looking at, interestingly, it was looking at how people's confidence level can be blown out of the water, through getting just a little bit of information. And it was called the Dun and Kruger Effect. And it was a couple guys, Dunning and Kruger, actually figured it out. They found that when people got a little information, they thought, wow, I really have this thing down. And then they started taking actions as if they really knew more than they did. And it was just a funny thing, is because people that really did know their stuff even were fooled by these people because of their level of confidence. But it was false confidence. And what happens is that people that are criminally intent, that they have with criminal intent, will actually go after people that are using self-directed IRAs and get them to do things that they probably shouldn't do. And especially as you get older, that becomes really bad because you become very much, much more prone to making decisions without necessarily having the cognitive ability. Unfortunately, folks, that's the way it is. You know, our fluid intelligence actually stops growing at age 45, like it or not. We don't have growth in that particular area. Now, crystallized intelligence, that can grow on forever, and that's where you're talking about experience. That's when you're giving advice to your grandson or your granddaughter, and that actually continues to grow on forever. That's great. But guess what? Fluid intelligence doesn't, but our confidence level doesn't seem to wane as we get older. So that's why it's really good to not go down this direction. Now, there are three more things that I'm going to talk about regarding this that have a big impact on whether this ends up being a successful way of doing things or not. And I'll talk about that more because it will have also some application to regular investing that you might do in general with your IRAs and your investment assets later on. Okay, self-directed IRAs, this is something that I was asked about this week. Figure we talk a little bit about it. And just so you don't just think it's just me, I like to actually pull things from, just written periodicals out there. This one, particular one, is Kiplinger, 6 Reasons to Avoid a Self-Directed IRA. Number one, it's not for the faint of heart. You know, a lot of the things that you can do with these things, with these types of investments, can be really, really dangerous. And one problem that you run into is lack of diversification. Second, lack of guidance. You may be really, really smart, but the reality of it is there's a tremendous amount of academic research on investing that you may just not be terribly aware of. Potential for fraud is another one. A lot of people are actually, Securities Exchange Commission in particular, warning people that criminals prey on those with self-directed IRAs. Another one is paying hefty fees. Self-directed IRAs aren't cheap. Along with transaction fees, the IRA custodian can charge an account setup fee, an annual fee, a per asset held in your account fee, and fees can be quite high in these things. But I think even more than that, the problem that you run into is you may be paying fees, but not necessarily getting advice, and could end up with tax bills on your hand that dwarf any kind of fees that you might end up paying. RMDs still apply with these, required minimum distributions. Now, this can get really tricky because you got to figure out the asset value every single year to determine how much money has to come out of this thing. And what he said here is, as self-directed IRAs are retirement plans, you'll still need to take required minimum distributions once you turn 72. That can be tricky to do if you're investing in assets that aren't easily cashed in. Let's say you got illiquid assets. You got a house and you can't cash it in. You don't go and cash in and sell the roof. I'm going to sell the roof this year. I'm going to sell the garage next year after that. Then there's a Roth IRA version. Like ordinary Roth IRAs, self-directed version is funded with post-tax dollars. But you can end up with some problems, and you lose key advantages with real estate. One of the benefits with real estate, and he points this out here, which I have pointed out many times on this show, is that you have the ability to depreciate real estate. Well, you lose that ability. You kiss goodbye many of the benefits associated with investing in property. Now, I'm not a big fan. I don't invest in property. I have some properties, but very, very small amount of my assets are in property, simply because I just don't like the idea of having to constantly keep up with it. It says, as the IRS has rules on self-directed IRAs, and one of them is that you cannot use or manage the assets personally. If you buy a beach house as an investment, you or your friends can't stay there for free. If the wind blows off the storm gutter, you can't fix it yourself, but need to hire a professional using cash from your IRA balance. If you get caught breaking those rules, the IRS could void your entire IRA, forcing you to take out the balance, not just the problem asset, which could mean a sizable tax bill and the loss of future tax benefits of these investments. Besides that, it's great. Not exciting in my mind. You also miss out on the tax breaks for owning investments outright. It's the IRA that holds title to the property, not you personally, and your IRA doesn't pay taxes each year. That's a problem for real estate owners, investors, as they won't be allowed to claim annual deductions for repairs, mortgage interest, depreciation, property taxes, losses against personal income. Just a lot of problems right there. Now, I promised I'd say something because, a lot of times I see gold used as this. And I remember I talked about this, back in 2008, 2009, because it was like everywhere you looked. And they're still out there. I don't even know why they're still out there. The return on gold has been so abysmal that it just amazes me that there are still commercials out there about investing your IRA in gold and silver. Well, they switch, depending on which one is doing okay at a particular point in time, they switch as to what they actually go and advertise on TV. But gold was everywhere. 2008, 2009. Talking about it. You need to do this. And I would shake my head and go, no. And people say, well, why, Paul? Gold has jumped. And at that point in time, gold had jumped in price. And I said, hey, look. They've been saying since 1980 that gold was going to hit 2,000 an ounce. And it hadn't. So, you look at that period of time and what stocks had done, and it's just ridiculous that gold had gone nowhere. And what happened was I'm doing these workshops on it, and somebody just says to me, so why not gold, Paul? And I said, look. It hit me one day I was on the radio. And I said, it has its own function for its own demise. And I forgot a friend of mine was on the radio with me and he goes, what are you talking about? I said, think about it. If gold goes up to the price that they keep saying it's going to go up to, then people will mine for it everywhere. And I kid you not, a couple years later, there were TV shows that came out talking about mining for gold. And they were following these people looking for gold, right? And I said, they're going to even go to the bottom of the sea. They're even going to go to the bottom of the sea and they're going to mine for gold down there if the price goes high enough, because the cost of getting mining equipment under the sea would be worth it. And I remember we were just talking about that and it's, that's interesting. No joke. In the Wall Street Journal this week, deep sea mining is close to reality. Now this is the funny part, because this is not for gold that they're looking at mining, but it's for metals that can be used to make electronic vehicles. No kidding. Now that you know that what they're mining for is not gold, because gold prices, they're not high enough to justify going and mining at the bottom of the ocean for it, because it never went up high enough, because it didn't do anything, right? But if we're talking about electronic vehicles that maybe you might have to drive because of kind of the way laws are going and what regulations are being forced upon us. Now, I personally think that other things are going to end up coming to fruition first, but just playing with it right here. Deep sea mining, I'm going to read the rest of the headline, is close to reality despite environmental concerns. Now, why are they talking about electronic vehicles? Environmental reasons. Now, why are we having to go to the bottom of the sea and screw up the environment? Because we want to save the environment, we got to go screw it up. You can't make up this stuff. You cannot make up this stuff. But I think just the point being is, look, when you have something that goes high in price and it is a commodity and it is high in value, why? Because it's scarce. The value is high because it's scarce. What people will do if the price gets high enough, they will get rid of the scarcity. They will increase the supply, and that will hence reduce the price, and it will have the function for its own demise, which is literally what I said 14 years ago. To me, it makes sense. It's logic. I don't think it was a big mental jump to say that would happen. But I just think it's interesting just to see that it is looking like it's going to happen. But it's not even for gold because gold never went up that high in price. It's car batteries. Go figure. Paul Winkler, investor coaching. So bottom line, self-directed IRAs, watch out for false confidence. False confidence is a killer when it comes to investing. Thinking that you know things that you don't know can cause you to do a lot of things that you will come to regret, but you might be suffering through your regret with a lot less money.